For the second class today, we're going to talk about the implementation of GASB 72. Presenting this class, we have Cody Smith and also Amy Myer. Cody is one of our supervisors, together with Amy. They are the leads for the GASB 72 implementation task force of our company. With that, please welcome Cody and Amy.
Hello. Well, thank you, Catherine, and good morning, everybody. Really appreciate everyone coming out here. I can't echo everyone's sentiments. We're really excited to have this training. Like David mentioned, we all know you guys are really busy, so to be able to take time out of your days to be here with us, it means a lot, and we appreciate it. So before I get a couple housekeeping items, first is, as many of you know, and for those of you who don't, we'll soon find out, I talk hurriedly sometimes, very rapidly. So if I talk too fast or something's inaudible, please raise your hand, speak up, dance around, however you like to do to get my attention. We can stop and go over it again. Also, we're going to have a formal Q&A session at the end of the presentation. That said, if you don't want to table your questions till the end, please feel free to raise your hands. Amy is the Q&A for this presentation as well, so we can ask you as it's fresh in your minds. We can stop. Like I said, we'd like to be a little more interactive. So with that said, does anyone have any questions before we begin? Cool. So GASB 72, fair value measurement application. Topics to be covered today will be effective date and transition. We have key definitions, the difference between entry price and exit price. We are going to go over the different levels of the hierarchy, level 1, 2, and 3. We have exceptions to fair value, which aren't many, but we have the list there. And then last but not least, probably the most important thing for everyone here is the reporting requirements, how they're going to affect the reports, your presentation. So with that said, the first thing is the effective date and transition. The effective date and transition starts June 15, 2015. So for all intents and purposes, it's fiscal years 2016 or calendar year 2016. For those entities that have a prior period comparison, the GASB requires a prior restatement so the information is comparable. This statement makes a clear distinction between something being inconvenient versus impractical. Impractical obviously would entail that it's impossible to get the information. It's unavailable. However, if it's difficult to get the information, it doesn't preclude you from making the change. So we have, for the most part, I'm assuming a lot of people are going to have to restate both years if you're showing comparative. But like I said, the statement does go over it. So like I said, for all intents and purposes, you're going to make the change for next year. Couple basic definitions we're going to get into. First is with GASB 72, there's a tweak to the fair value definition, and really the definition has been expanded. Most people, I would assume, me included, usually think about fair value or think about assets. GASB 72 expanded the definition to include liabilities too. So it's not only the price paid to get an asset, but it's also the price received to sell an asset, but it's also the amount paid to dispose of a liability. So it's expanded the fair value definition to include both sides of the balance sheet. The other thing to note is that and we'll go over this in terms of an orderly transaction. For those entities that are like going over bankruptcy proceedings or liquidation, those are distressed sales. As many of you know reading the paper, when there's a bankruptcy, you're selling your assets, you're liquidating your items for pennies on the dollar. These are, for GASB 72, the assumption is that there is no bankruptcy, nothing's distressed, nothing's getting liquidated. So it's an orderly transaction between willing market participants. There's no regulatory or legal hurdles forcing anyone to sell anything or get rid of anything that they don't want to. Other basic definitions is the measurement date is an asset or the date the asset or liability is being valued. Typically it's going to be your fiscal year end, so I'm assuming most people here are June 30s or 12/31s, but it can be another date. For instance, say the market is closed. Say you have a lot of level 1 inputs, and we'll get into level 1 inputs here shortly, but say you have a lot of like stocks and bonds that are actively traded on like the NASDAQ or the New York Stock Exchange, and say in theory, your fiscal year end date ends on Christmas. Obviously, the stock exchange is closed that day. So you take the next available day and value your assets and liabilities on that day. So it kind of expands the use, but for the most part, it will be June 30s or 12/31s. The next definition we have here is the highest and best use assumption, and this just pretty much much optimizes, the thought behind this is optimizing the value of the asset. So a good example, we say you have a piece of land. The land is zoned as residential, and the city or a governmental entity intends to rezone the land to commercial. And say, in our example, residential costs a little bit less than a commercial land. You're in the process of getting it to be commercial, but it's still residential as a fiscal year end date or your measurement date. So you have to value the asset according to what it's used for. So in our case, it would be still residential at June 30. After it's voted commercial, next time around, you get it at the measurement date, it'll be valued at a commercial date. So you just want to maximize the value of the assets and liabilities. So unit of account, in the statement, this is important because this will help determine which level of the hierarchy you're going to record your assets or liabilities. Basically, the premise is say you're invested in a hedge fund as an investment. Obviously, a hedge fund is going to have a ton of different investments, commodities, securities, bonds. So typically, in a hedge fund, you're going to value as a percentage or shares of the hedge fund. You're not going to value each different individual investment or security within the hedge fund. So the unit of account would be shares in the hedge fund or percentage owned of the hedge fund. Conversely, if you're doing your own investment trading, your own investment managing, and you own your own securities, you own your own bond issues, then the unit of account is going to change to the individual securities. So again, it's a different, just the different focus. One thing we'll get into in a later slide is once you determine the unit of account, it stays the same. So you can't go 1 year, hey, we're going to invest it as percentage shares owned in an investment portfolio, and then next you do a little research and you realize, hey, actually if we just value the investments that were in the individual hedge fund itself, you can't switch all of a sudden and increase your assets. So unless there's some type of regulatory or legal situation that arises, even politics, we all know sometimes politics happens, the unit of account will stay the same year to year. An active market, again, we kind of touched on this earlier, is just an active market where it's really just high frequency, high volume transactions. So again, think of your NASDAQ, New York Stock Exchange, the Nikkei in Japan, very high volume, high frequency trades. Again, and it's, I would like to point out before we get too far ahead is that in terms of classifying which level an asset or liability in, the frequency will be taken into consideration. So like I said, and for the most part, all level ones will be an active market because it's quoted prices all the time. If the volume would go down, it's a less active market, thereby it may end up having the classification be dropped to a level 2. So it's important to keep in mind where the asset and liability is being traded at all times. So continuing on with our definitions, inputs are just assumptions about how to value the asset or liability. And they can be observable or unobservable. Easy ones are just price-earnings ratios. It could be a piece of land about where it's located. Obviously, maybe a piece of land here in the Bay Area might be a little more expensive than a piece of land maybe in like Kansas. So there's different inputs. But like I said, these are just the factors that are being used in order to create a value, a fair value for your asset or liability. Next we have here is just the different levels, level 1, 2, and 3. The first level 1 is quoted prices in active markets. So again, that's why the key is that they have to be active, it has to be fluid, constantly having information. Level 2 is inputs other than quoted prices within level 1. Like I touched on earlier, say for instance you owned a corporate debt bond issuance. Assuming a city or a governmental entity didn't buy the entire corporate bond issuance, obviously you own just a portion, a segment of it. If that QSIP that is related to the entire corporate bond issue is traded frequently, every single day there's trades on it, there's constant movement, constant, then that would be a level 1 input. Conversely, that same QSIP, say, is traded once every few months. Maybe, actually, I shouldn't put parameters on the length of frequency, but in this example, if it was traded as actively as every other day or all the time, then it would be dropped to a level 2. So there's a slight differentiation with that. One of our investment managers, investment advisors that we've been in touch with also backed that up, collaborated with that. So we feel comfortable saying that level 1 will be higher, highly active, and level 2 is with the frequency will be a little bit less. Level 3 inputs is unobservable inputs. Honestly, when I first heard level 3, I was like, unobservable, that doesn't make any sense. How can I value something I can't observe? A good example would just be a land appraisal or even private or venture capitalists valuations. For instance, Uber's a unicorn. It's a company over $1 billion. However, it's not publicly traded. It's got, however the valuation is, it's obviously through rounds of funding, and people come up with multiples and create a valuation. I think it's at, I don't know, $4 billion now at the last thing, or maybe it's something even crazier. Anyhow, that's an unobservable input. It's not actively traded unless you know somebody inside who's valuing the company, who's part of the VC firm. You're not going to know how much it is. So if you maybe had a stake in Uber, first of all, congrats. And secondly, you know, that would be a level 3 input because you don't know what's going into that valuation. I hope that makes sense. So the next topic we want to get into is just entry price and exit price. GASB 72 really moved away from entry price. And entry price in layman's term is just money that you get in to acquire something. It's money in the door or provided to get rid of a liability. So that was the old rules. The entry price applies to donated works of art, or excuse me, donated capital assets, works of art, and historical treasures. So kind of self-explanatory. GASB 72 now moves from entry price to exit price, and like I said, this is pretty much money out the door. So it's not, instead of having the amount paid, it's the amount received to sell an asset. So two different aspects of the transaction cycle, but it's good to focus on that. We want to be, it's amount paid versus, or excuse me, amount received or paid for a liability. One thing to note is that transaction costs are excluded from the fair value price. So if you pay money to enter a market, say a certain bond market, or your government entity has a poor credit rating and they have to pay a finder's fee to be able to even access the certain market, then that fee would not be included as the price of the asset. The one exception is if the transaction price is undistinguishable, so it can't be, you know, just part of the purchase price, gets a catch-all, then it would be included. Other thing to note is that highest and best use, like we touched on earlier, is going to be, at all times, it always has to be applied. So this includes non-performance risk. So non-performance risk is the default rate. Some companies obviously, or excuse me, some government entities have higher ratings. That's why we have Moody's, that's why we have S&P. So obviously a government entity that has a better rating is going to have maybe not pay as much for a certain asset. So that is all factored into the calculation of fair value. Last but not least is present service capacity, and this kind of goes along the highest and best use. Again, with our example, piece of land, you're trying to make it commercial, it's still residential. You cannot value it at commercial, even though the intent is there, even though it may be valued more as commercial property, it will still be valued as residential. So with that, just kind of any questions before we kind of get into the nuts and bolts? Anything? Okay, cool. So next we're going to just kind of go into the levels, level 1, 2, and 3. Obviously, there's only three levels. Each level has different reporting requirements. If you think about it, just basically a level 1, since there's quoted prices, the disclosures aren't going to be as so, there's not going to be as much, for lack of better terms, because obviously it's quoted prices. Everyone go online, you go to Yahoo Finance, look it up, Google, it's easy to do. Obviously we get to level 2s and level 3s, particularly about unobservable inputs, and also just level inputs that aren't quoted, or level 1 inputs that aren't quoted prices for level 2. Obviously disclosure is going to be a little more scaled up. You're going to have to kind of explain what's going on, your valuation techniques applied, of that nature. One thing to note is if you have a investment or a liability that has two different types of inputs. So it has level 1 inputs, quoted prices, but also has an unobservable factor. So you get an appraisal or maybe an actuary, or that's actually, yeah, you get an actuary, and they're factoring in information that also includes level 1s and maybe a level 3. It'll be classified according to the lowest level. So in this example, it would be a level 3 category. Again, so you have level 1s and you have level 3s, it'd be a level 3. The statement also kind of clarifies that it really prioritizes inputs over valuation techniques. Just because you use a specific valuation technique, really the focus is on the assumptions used to create that valuation. So even if you use, say, bond matrix pricing to classify or to determine the fair value of your investments. If you're using level 1 inputs, despite using a valuation technique that should be really level 2, it'll be a level 1 investment. As a caveat, I would say that you wouldn't use bond matrix pricing unless you didn't have quoted prices, so, but in theory that's how it would work. So, last but not least is just unit of account, like we touched on earlier, is it remains the same throughout. Unless there's some regulatory or legal hurdles that'll happen, it stays the same throughout. So the first level we have is just level 1, high frequency, high volume. Think Alphabet, the parent of Google, Microsoft, McDonald's. These are all just a high frequency, high volume transactions. Anyone get the information all the time. One thing to note is blockage factor is not an input. Blockage factor is just where, say you're in a consortium where you're going to buy a bunch of different securities at once in one block. Sometimes there's a discount that's applied because you're buying so much at one time. Think Costco. I can buy, go to Safeway and buy 1 bottle of ketchup, and then I go to Costco and buy 30. All of a sudden it's $30 cheaper. That factor, that discount, wouldn't be included in your fair value measurement. Also, one thing to note is that under this new GASB, because it expanded to include liabilities, that if you have a liability with an identical asset, the liability will be valued according to how much value the asset is. So think again like you issue a bond, you have a bond issuance, and you value the asset at, or excuse me, value the liability at $10. On the open market, it's trading for 15. So even though you say it's worth 10, the market says it's 15 as an asset, you would value that liability as an asset. Obviously, most of the time, there's going to be differences between non-performance risk with different credit ratings, and so that also is taken into consideration. So if you're not comparing apples to apples, obviously you can't say, okay, it's now worth 15, it would still be $10. But it is worth noting that, again, if there's an identical asset for the liability you own, then you have to value that liability for it. Last but not least, just net asset value can be used as a level 1 input. Net asset value is strictly just assets minus liabilities divided by shares. If you can use, and again, if market participants are willing to pay more money for that net asset value besides the calculation, then you would value it according to what the market participants are willing to pay. So level 1 inputs is pretty basic, but like I said, I would say the most thing what to touch on is just the frequency in which the transactions are occurring, because level 2 is it's other observable inputs besides level 1. So again, we have examples here. Investments, interest rate swaps based on the LIBOR. That's LIBOR's London Interbank overnight rate. So it's about the rates banks charge each other for one-night loans. So interest rate swaps aren't active. I mean, they're using level 1 inputs, but they're not really that observable. They're not happening all the time. I only know a few instances where I've encountered that. So that obviously is using information that's readily available, but it's not happening at such frequency where it's going to elevate to a level 1. Other examples would be investments with matrix pricing and then valuation multiples. So again, you're taking level 1 inputs, you're sticking them into a valuation technique calculation, and then creating a level 2 input. So that is a difference between level 1 and level 2. One thing to note too is, like I said earlier, is that matrix pricing and valuation multiples, you wouldn't use these techniques unless you had quoted prices. So it's kind of a good way to think about it, determining which level 1 or level 2 they are. Because of the fact that the information isn't that readily available, you have to kind of collect them together, collect the soup together to make something, to price it. So that's one thing to note, is that if you're using a valuation technique over an investment or a liability that's really pulling a lot more information from all over the place, then it'll be a level 2. And like we touched on earlier, the frequency in which a asset or liability is traded will also be included. It's good to remember, because a lot of investments, when we were first going over this statement, that I assumed would be level 1s, U.S. agency securities, because the frequency, most places buy and hold them, the security is not being traded constantly. Rather than being a level 1, even though online you can go up, look up the QSIP, you can get an active market price, because it's not traded all the time, it'll be a level 2 classification. So I thought that kind of strange, and I didn't assume that was going to be. So level 3, again, is just unobservable inputs. Good example is mortgage-based securities. I'm sure everyone remembers the financial crash. A mortgage-based security would be level 3 because when they package all the mortgages together, no one really knows the underlying mortgages themselves, the traits. You don't know who the borrower is, you don't know where the home is, you don't know the interest rates on it, you don't know the default rate of the borrower, but they're obviously collecting them together and then they're selling them, packaging them as one single investment and selling them. In that example, no one really knows how much the individual mortgages are, but we do know the individual price. So because there's so much unknown or unobservable inputs, that's a level 3. Same thing with with VC firms, venture capital firms, and all the private companies. You read a lot of articles in the paper recently just about unicorns. Again, companies over $1 billion. I mean, this is somebody's. I mean, I'm sure they're really smart and they know what they're doing, but I mean, they could go publicly traded and then fall flat. I've seen plenty of instances of IPOs where a company goes public, they value their stock price at 15, and all of a sudden hits the market and it bottoms out at 7. So again, until it hits the market and you don't know what the inputs are, then it's obviously a level 3. The last example, which is probably the most pertinent to the people in this room, is just land appraisals. Again, you're having someone come out, look at your building, determine the land, the zoning, you know, does it have lots of rats? I don't know, whatever they do where they're looking at lands, land and buildings and appraisals. But that would probably be the pertinent, and anytime you get an appraisal, that would be a level 3 input because you're combining a lot of inputs that aren't necessarily readily available. I couldn't tell you how to do an appraisal, so. So sometimes, kind of like we touched on a few times, is you're going to have some changes to the level of the classification. There's only a few instances, we kind of went over them already, but briefly, it's just the volume of trading increases and decreases. A good example, well, I shouldn't probably get that, but is this the frequency goes up and down. So you have one QSIP that may be actively traded on the onset, and then later down the road it's not for whatever reason, or certain markets are opened up. I would say, you know, there's a lot of ETFs, exchange traded funds, about marijuana growers. Obviously right now they're very low volume trading. You know, I know a lot of people that are involved with them are hoping that they obviously the government legalizes it. Once it does, obviously maybe you're an ETF and it's traded at a level 3 because it's not actively traded. Once it becomes legalized, the government says it's okay, and all of a sudden there's all these marijuana stocks, and all of a sudden, boom, it's now a level 1. So that's a good example of a market opening up that may not be, you know, maybe using unobservable inputs, and maybe later down the road will be a level 1 input because now it's being bought and sold regularly. Other thing to touch on is just valuation techniques. Again, if information isn't available and you're forced to use a different valuation technique, that could change the classification. One thing to note is if you do have to change it, you don't have to restate prior periods. It's just a change in estimate. So you won't have to go back and redo everything. You just have a disclosure, explain why there's a different valuation technique being used as a footnote, and that's really it. So last but not least is just exceptions to fair value measurements. First one here is just money markets and will be CDs and money markets, less than 1 year. These are valued over cost and amortized basis. And the reason for that is just because of the fact that it's so close to $1, there really is no sense in valuing it all the time and recording all those fluctuations is just pretty much a waste of everyone's time. So it's so close to the maturity date, the statement allows an exception for it. Life insurance contracts for employees, so those you actually are buying for your employees as maybe a benefit for them, those are valued as cash surrender value. One thing the statement does note that if you are in the business of buying and selling life insurance contracts as an actual investment vehicle, those would fall under this GASB, and those would be valued under GASB 72. I would assume a lot of places here aren't in the investments of buying and selling life insurance contracts as an investment, so hopefully that doesn't come in effect. We also have synthetic guaranteed investment contracts, GICs, we call them here at Mays. They're just at the contract value. Next thing is 2A7, like external investment pools. This is like CAMP. CAMP is the California Asset Management Pool. CAMP is a 2A7, like external investment pool. So that would be valued at amortized cost rather than just valuing at fair value constantly. And then equity interest in common stock, it's also valued at the equity interest. You can see paragraph 77 of statement 72. There's some very light reading there for you guys if you're very interested in that. So, okay, so before we kind of get into the reporting requirements, is there any questions about just the rubric of what the different levels are, classifications? I'm sure most people here are really interested on how it's going to affect the financials.
You mentioned land as an example, so only land held for sale is going to be covered under this GASB, right?
No, it would be all land. His question is just land held for resale covered under this GASB, or all land?
No, land held for resale would not, because land held for resale is recorded at lower of cost or net realizable value, not fair value. If the definition did say fair value, then it would be subject to it, but net realizable value is a little different because it's, if you know you're going to sell it for $1, then you write it down to the dollar, but it'll remain on your books at the lower of those two balances, so it's not affected. So it does affect land if it's donated land, or actually, it would just be donated land is what it's going to affect. It's going to affect your donated capital assets, because you're now going to record it at estimated acquisition cost. It used to be donated fair value. He's going to have the statement in a minute, but it's used to be recorded at estimated fair value at the date of donation. Now it's going to say estimated acquisition cost is going to be your disclosure, because again, it's that entry versus exit price, and so that's what you'll be recording it, and he's going to go over it in a minute.
Anyone else? Cool. Okay, so reporting requirements. And these are in no particular order, so it's not like any importance. I kind of put them together. And a lot of these, I would say, before we get into is that one of the things about the GASBs is this isn't an accounting statement. So most people, or most entities aren't going to have any changes to what you guys have been doing the entire time in the past. All it is really is just expanding the disclosures. So once you get the information, and we would suggest also is talking to your investment manager or investment advisor ahead of time. One thing to note is that you guys, the governmental entities that we're auditing, have to make the determination which level or which bucket they fall into, and then we come in and determine if your assessment is correct or not. But again, what we'd suggest is, contact your investment manager, contact your investment advisor, ask them, hey, are you going to provide this information? If not, like, how can we get our hands on it? I know one example, I think Chandler, if I'm not mistaken, we spoke to Chandler, and Amy could probably touch on this a little more than...
Yeah, we've asked a couple of entities, because again, this isn't something for your cash and investments, or not cash, sorry, for your investments. It's not something that you're going to necessarily need to go do yourselves. Hopefully they're going to provide that information, and so you want to start contacting them now, because they are aware of it. Chandler Asset Management is planning on providing statements to their entities that are their clients. A few others have said that that the investment manager is not going to provide it. The client needs to contact the safekeeper for that information. So then it's walking down that path to find the entity that's going to provide you the information, because they're providing you fair value on the statements each month. You only really need this information at the end of the year for disclosure, but are they going to provide it? And if they're not, then what path do you need to walk down to figure out how they determined the fair value for the investments at year end?
Okay, cool. So yeah, and the other thing to note too is just you're able to present this information in tabular or narrative form. So if you like writing, you have your English major and you really want to write a paragraph, go right ahead. If you like to be a little more bullets and tables, you can also use that method too. So either method is fine, as long as the information is in there. And another thing, like I said, the other thing to note is really the biggest change is just the level 1, 2, and 3 classification. Most otherwise, everything you guys have done in the past will still be applied or applicable. So for instance, the nature characteristics of the risk associated with the assets and liabilities. So that'll be like in a summary disclosure, kind of when you're at your beginning. Most entities have like a footnote 1 disclosing what compensated absences are made of, how your capital assets are valued. You're also going to add a disclosure talking about just the different levels and how things are valued, and it just be an additional disclosure. So something, you're just kind of expanding upon it. Next, we're going to touch on just the different levels. Obviously, with them breaking out different level 1, 2, and 3, you're going to need to determine which level of the hierarchy you're classifying your assets and liabilities. One thing to note is if you have the same asset or liability for different uses. So a good example would be a hedge fund. You have a hedge fund that actually is used as an actual hedge versus a hedge fund that's an investment vehicle. You would need to disclose the differences between the two. Kind of a no-brainer, but they do make a big fuss in the statement about this. So we just want to bring that to everyone's attention. The objective or mission of the government also is included. You kind of just want to let people know what the intent. Obviously, maybe a CalPERS is there to turn a profit, whereas like a general purpose government obviously isn't there to really turn a profit. So the distinction between the two is recommended to be disclosed, or not recommended, is required to be disclosed because of the fact that obviously CalPERS investments you're going to look at as maybe higher volume, higher frequency, whereas a general purpose government isn't going to have that information. So you just want to know the relative sensitivity of the investments, or I shouldn't say investments, but the sensitivity of the assets and liabilities being valued under the new GASB. So other reporting requirements, here's just characteristics of the government. And this kind of falls into the concentration risk that everyone's already kind of been accustomed to. I believe the rule is if you have 5% of one type investment, obviously excluding money markets, treasuries, I forget the other things, but if you have more than 5%, it's a disclosable item. The reason why you want a characteristic of the government is going to be defined as, say you have a component unit, and the component unit is invested in U.S. agency securities. Obviously, you want to define what the component unit is, and it may have 5%, where in the actual component unit financial statements, say you issue a separate housing authority financial statement, you're going to disclose, hey, the U.S. agency securities are over 5%. We can then disclose that. But when combined with the city, the percentage goes down. Therefore, all of a sudden now it's not disclosed. So you want to make that distinction. Again, this usually is already included in your summary accounting footnote, when it discloses governmental fund types, business fund types, different component units. So that's already being taken care of, but they just make sure that, because this will affect how you disaggregate the information. So again, our example, use having a housing authority, you may need to present the different concentration risks versus the city as a whole, you won't. So that's pretty much takes care of characteristics, relative significance, and separately issued financial statements. Again, you just want to make note that if you have a separate component unit issuing separate financial statements, you make note of it. I think everyone's already doing that already. Another thing to note is with GASB 68, they had the same thing about you needed to require, or not require, but you should disaggregate the information in the balance sheet or statement of net position. With GASB 68, for those of you that are our Maze clients, we had the deferred inflows related to pension footnote related to GASB 68, and then in the footnote it would reference you to a note in the back, and then the note in the back had a table where it expanded everything out. You're able to do that as well. I would assume most entities are going to prescribe to having a note reference rather than having a myriad of different investments listed on the face of their balance sheet just because it looks a little messy. That said, if you like it messy, go right ahead. We're not here to, they are your financial statements, so do with them what you wish. And last but not least, is just the most important one, is just the description of the valuation technique used. Really, this is going to apply to level 2s and level 3s because we're going to have a basic level 1 definition, quoted prices and active markets. I mean, it's pretty simple. Level 2 and level 3, you're going to use different calculations or different valuation techniques to do that, so that's where this will come into play. So we have a couple examples here, and I'm sure those people in the back can't read this. Hopefully everyone got a handout so you can see it. This is our basic fair value measurement template. It goes over, defines fair value. It explains the hierarchy on a very macro focus. It also discusses inputs over valuations like we touched on earlier, and it talks about the lowest input. So this will just be a general disclosure. This is how all the assets and liabilities are now being valued. Like I said, it expands to not just include assets, and it'll just be included. This will be an additional disclosure in your first part. Maybe it's note 1, maybe it's note 2, but just a general rubric here. Next thing we have here is for an investments footnote, example disclosure. Again, it kind of just reiterates what the different levels are, kind of higher level focus. It's very simple. But the next one actually is probably where the teeth of it comes in. One thing to note is well, this is our table that we have, and technically the requirement, to skip ahead one here, is they require this paragraph, and this discloses what levels they are. It talks about different, the type and the amount. It also discloses the valuation techniques. This is what's required. That said, we prefer, here at Mays, we prefer this table just because it looks nicer. It's easier to read. You will have to have both, but the table is optional. So if you like to want it, does less is more, just go with the paragraph. We like both. I mean, well, you have to have the paragraph, but the table seems a lot cleaner, a lot more fluid, so we would recommend doing both. The other thing to note is that we're a little unsure. We're trying to get some guidance right now at the moment, but this exempt column here, we're a little unsure because you're going to have some investments or even some liabilities that are exempt. They're just not valued under any of the different tiers. We theoretically are thinking that we're going to have an exempt column. You may, after we get some guidance from it, it may be taken out altogether, but we just want to put the little star next to this that we don't know. This is an example and we're waiting to get some information more, but this is how theoretically we think it should work. So does anyone have any questions about the tables or footnotes or anything like that? The one thing to note too is obviously the 2 blanks for level 2s and level 3s. Like I said, we don't know the valuation techniques being used, so we left them blank. You should not put a blank line in your footnote, just to clarify. Yeah, exactly. So, and like Amy had touched on earlier, it's just the capital asset, SSAP's summary of significant accounting policies. For those of you who are clients currently, we kind of have that. It's note 1 usually, goes over everything. So, like Amy touched on with WACAS, is that the prior disclosure was estimated fair value on the date contributed, and like we talked about with the entry versus exit price slide, is that contributed capital assets are going to be entry price. So the focus is on how much on the acquisition value rather than the estimated fair value. So it's switching the focus from the first sentence on this example is exit price, and now with GASB 72, donated capital assets are acquisition price. So this is a good example of the former was exit price and now it's entry price. So we also have some resources in case you have trouble falling asleep at night. You are welcome to read this. It is a lot of fun. The GASB does a good job of using very big font, so the book looks a lot bigger than it needs to be. It's probably because they think everyone's reading at night to go to sleep. So, but there's 2 GASBs here. There's links here to do it. I would recommend just using the focus fact sheet. It's a nice Q&A. It goes over a lot of examples. So if you have trouble trying to determine which levels or what type of presentation you want to use, it's really helpful. And then obviously 72, the actual statement is pretty thorough. So that said, is there any other questions we have?
Yes. Yes.
Yeah.
Back to that table, the held by trustees, money market mutual funds. Why are those exempt? Is it because the investment decision has been made by the trustees?
So it doesn't have to do with that. The question was why on the example footnote table, why the money market mutual funds held by a trustee are exempt. This is just this sample footnote disclosure. It doesn't matter if they're held by the trustee or if it's a direct city investment. Money market mutual funds, if they have the net asset value of $1, That's why they're exempt. There's no fair value adjustment. Each share is worth $1, and so they're exempt from the fair value level, the level disclosure. Yes. Any other questions? Yes.
What about the updates that get updated when some of the instructors suggest that we're not sure of the levels, like it's safer to put investment in level 2? What do you think?
So the question, if I understood the question right, when you get in the level information, if you have investments where you're not sure of the level, the suggestion is to use level 2, and that is being more conservative, because again, level 1 is investments for investments. It's in an active market for an identical investment. So if it's not really clear that your investment is identical, same in an active market, you're looking at the QSIP, has it been traded recently? You know, and like Cody said, we can't put a time frame on it. Recently, active, whatever the definition of active, you can define that. Then you would default to level 2. Then you determine how then you disclose how you've made that determination. What's the basis? What's the methodology? What were the inputs you used? So you may use level 1 inputs for similar assets, but not identical assets to determine the fair value. Brad.
So would real estate held for investment be a level 2 or 3?
So real estate held for investment is going to be how you value it. So most real estate is usually going to be a level 3, usually because you're going to rely upon an appraisal or something, again, that has an unobservable, you have more than one person that's going to give a quote, all their answers could be different, and you might take the average of them. Other unobservable inputs could be the government's own records. If you have someone on staff that's doing an estimate for the value of that property, then you disclose the basis for it. How did you determine that fair value for that particular investment? And it's disclosed, and it would be level 3 if it's something. Again, 1 is active market, identical asset. Yes? Ooh, we didn't even look to that. That's a very good question. Investments in a joint powers authority, do those follow? Anything that is required to be reported at fair value is affected by this statement. So, depends on how the investment is valued. Probably not. So the statement was that it's any investment to make money. I agree, it's probably not, because that value is going to be based on some other basis for the JPA, because they're not usually, it's usually based on some calculation or factor from the Joint Powers Authority's financial statements, right? It's some share of the equity or some other basis for that investment is how you've recorded it. So it's probably, because it's anywhere in the GASB where the term fair value is used, any of those, that's what this, where this definition, or excuse me, where this statement is applicable. And that's why if you were to look at because again, as Cody said, if you're tired but you can't fall asleep, and you look to the back of the GASB statement itself, there's a whole section that shows all of the places in the GASB codification that were revised by this statement. And so you can find all of those reading. And again, I'm sure you've all done that with every statement that comes out, haven't you? Yes. Correct. Land held for resale, correct. That's not held. That's land held for resale is not subject to this statement. It is not subject to it. Mm-hmm. And so, any other questions before I go into a few? Yes. That's going to be my next comment. Perfect timing. So that's one point to make of this statement. This is a reporting statement, not an accounting statement. So it's just disclosure. It doesn't matter whether anything's level 1, 2, or 3. It doesn't affect any numbers in your financial statements. It just affects the disclosures. And so that's what, even though in the GASB they use the term restatement, it just means for disclosure. If you happen to have comparative financial statements, if you're a special district that shows comparative financial statements, and so your footnote includes the current year cash and investment disclosure and the prior year, that's where you would restate the prior year disclosure. to be comparative and to show the information. And so that's what they mean when they say restatement, because we all think of restatement as meaning restating the numbers, but in this particular example, it's just disclosure would be restated. If, and that was the if practical, no, practical doesn't matter. What's the term? It can't be because of inconvenient. It has to be, unavailable. Any other questions? We had a couple of other things we were just going to point out. Again, some other confusing points of it. The blockage factor, Cody talked about blockage factor not being an input, is not considered an input. Another example of a blockage factor would be the size of the government's holding. If you happen to hold a large percentage of a particular investment and the market volume was not large enough to absorb your holding, that is considered that's a blockage to the trading, but that is not factored into the level 1 or 2 input. If that particular investment still is itself actively traded and there is a quoted price for an identical asset, it still could be a level 1, even though the market couldn't handle your particular investment if it were to be traded. Some other points we've talked about. 2A7 like pools enough today. So we talked about if separately issued, when you're going to the disclosures, and the primary government may want to summarize some of the disclosures a little bit more, just to help the reader, especially if information is available in separately issued financials, like if you've got a component unit or a pension plan that issues separate financial statements, and it has to have a very detailed disclosure for the investments and the levels and the basis. You can then summarize it for the primary government and refer to those separately issued financial statements and not need to talk about all of those individual items again. So hopefully that will help some of you. And we talked about effective date. It is due this year. Yes, this is the year. I'm sure you're all so excited. I think the biggest point is, as we pointed out earlier, is to talk to your investment advisors and your or safekeepers to find out who is going to help you get this information.